Welcome back to Retirement News Online. A common strategy in retirement planning is known as the Rule of 100. It states that individuals should hold a percentage of stocks equal to 100 minus their age. So, as an example, if you're age 60, 40% of the portfolio should be equities and 60% should be held in something conservative or otherwise fixed rate investments like bonds, treasuries, and CDs. However, many of these investments are paying next to nothing right now, so to compensate, many investors' equity exposure might be too high for their age. Now, there are alternatives in the forms of fixed indexed annuities. My guest is John Starke. John, let's start out by talking about how an FIA works, a fixed indexed annuity.
Well, Scott, first of all, thank you for having me again today. I really appreciate it. Fixed index annuity is something that's come about and become very popular in recent years. When I talk about fixed index annuities and when I talk about what people who've maybe bought annuities, say 10, 15, 20 years ago, I said, this is not your father's annuity. This is an entirely different product. And these products have been very beneficial in recent years because the fixed index annuity allows the client to invest their money in a product that can protect them on the downside and still participate on the upside. It's really having your cake and eat it too. And that's why many of the new fixed index annuity products, once we show them to people, they say, well, gee, that's not what I bought 15 years ago. That's not what my father had. They realize these products are a lot better as far as making your financial stability, financial program much better shape. The fact is you protect yourself from the downside. Market volatility is always going to exist. This is a way that you can alleviate that volatility and still participate in the good markets. And they allow a lot of protection there because you do protect yourself totally from the downside in many cases, and then grab the upside. So again, it's a wonderful product. It works for many clients. I like to sit down with them, see if annuity is right for their personal situation, and then from that point there, if it is right, then we find the right annuity that'll work for them and explain it to them, and then really works real well in many of their portfolios.
So John, how is this different than a variable annuity?
Scott, a VA is it's a variable annuity. It's traditionally a securities product, and it's really tied totally into the market itself. The disadvantage to a VA is it does tie it into the market itself. So therefore, people who owned a VA back in 2008 found out the hard way when the market was down over 30, 40% in many cases across the board in all the indexes. It also, the VA, depending on what you invest in, can be up very strongly and it can be down very strongly. So it is a lot more volatility than many people like to have in their portfolio now. That's why the index of variable annuity that evolved in recent years has been a very successful product, and many people like that in their portfolio.
So one thing that's common with a VA are fees. What about the fixed indexed annuity?
There are fees with most index annuities. Many of them are a lot less fees than we had in the past. We explain the fees with that basically related to the various sub-accounts they select. And in most cases, these are the indexes they select. And the fees are basically commensurate to the program itself. And I think in most cases, many of the major index annuity carriers have very moderate fees.
So if someone is considering the purchase of a fixed indexed product, what questions should they be asking?
Well, Scott, first thing I do is I sit down and do a complete interview with a person, basically saying, you've been asking about fixed index annuities, will this work in my portfolio? And be honest with you, Scott, that includes a complete, basically investigation in their entire financial situation. I like to find out where they are now, where they want to be in 5 years. What they see is a handicap of their long-term prognosis of their investments, and what do they see is what they were trying to achieve. That's why we try to find out everything the client wants to have and achieve. That's why a complete interview has to come in. We want to know how much money they want in the future. Do they want growth? Do they want to leave a legacy to maybe heirs or other beneficiaries? My job is to find all that out. And in addition to that, find out if the income level is suitable for them. Will they need to offset what they're getting from other fixed sources like pensions and Social Security and other investments? So the bottom line is that's how we find out what if the fixed annuity is going to do for them and if it is a good integral part of their investment and retirement plan.
That's John Starke. Thanks for watching Retirement News Online.